Okay, let's talk about North America then. As many of you know, the North American market has been difficult. And within that, our performance has been deteriorating, with us losing share declines across around 65% of our business. Actually, before I get to talk about my first 100 days, I just do want to call out that Canada within that has been quite robust, with strong top-line growth, good share growth. So really, I'm going to just focus this presentation on the US. So look, I've been about 100 days in a role. I've carried out a deep diagnostic on the business and already begun to make some interventions to course correct and to make this business more competitive. The drivers of underperformance range from long-term declines in some of our core brands through to over exposure to premium, under exposure to RTD and small formats, and an operating model that is quite cumbersome. So I'm going to unpack each one of these drivers during the course of my presentation. Let me first of all, though, start with the first issue, which is a number of brands. I'm going to talk about 3 in particular that have been in long-term decline. Let's talk about Crown Royal. It's our second biggest brand in the US, okay? But the strong growth of flavors has masked the underlying growth in this business. Crown Royal Deluxe is losing heartland consumers. Those heartland consumers are in very specific states. About 12 states in the US account for 70% of the Deluxe decline. Our number one strategic priority on Crown Deluxe is to stop the hemorrhaging and to hold on to those loyal consumers. So, how are we going to do that? First of all, we're going to introduce a unified, cohesive trademark campaign, which we just launched in June, called Bring It. What I like about this campaign is it allows to activate 2 important platforms for those heartland consumers. NFL football, where we sponsor 18 NFL teams, so we can activate locally, put drinks in hands. And secondly, country music lifestyle. This visual on the left, Realtree, is a hunting lifestyle brand. You may not be au fait with it. Our LTO sold $25 million. So it's that kind of heartland activation that I think is going to be strategically important for us moving forward. When I look at the packaging, I think we can improve a lot. On the one hand, I like the premium glass iconic bottle that we have. On the other hand, we've cheapened it by adding a plastic cap to it. We will be rectifying that. We have the inconsistent use of the purple iconic box on shelf, which reduces our on-shelf impact. And we will further reduce that on-shelf impact by introducing a range of flavors with different colors. We need to implement a more cohesive brand identity, dialing up the iconic Deluxe Purple. Now, there is a role for flavors. It does bring in new consumers, but we need to be more disciplined in how we do that. And I'm particularly interested in the role for flavors and innovation in what it can do to support our core Deluxe brand in holding on to those heartland consumers. And of course, putting Deluxe and flavors into much higher quality, especially higher quality small formats, than what we've been doing thus far. The second brand, which has been in long-term decline, is Smirnoff. It's been losing share for 8 years. Let's start with fixing the proposition. This is what we've put out in the last 5 years. Inconsistency of campaign, chopping and changing it a lot. You cannot build brand distinctivity when you're that inconsistent. We are urgently working on a new cohesive trademark campaign that will start to rebuild the distinctivity of this brand the way we've done in other markets. Critically, we're going to start managing Smirnoff as a single trademark, both Smirnoff Core and Smirnoff Ice together. That's particularly important in the US, where we have historically been running them in 2 different divisions run by 2 different leaders, which is no longer the case. And I'll come back and talk about the operating model in a little while. Now, as I've traveled around the US in the last 3 months, I've been struck by how poor on shelf we look with Smirnoff. There's a number of packaging missteps that we've taken, which I'm currently undoing. We're going to move from recycled PET, which is cloudy and opaque, hard to see through, to virgin PET. Purity, after all, is at the heart of this proposition. We're going to have both virgin PET and glass on shelf together. After all, different consumers require different packaging for different occasions. And finally, we're going to add back the handle on our biggest SKU, the 175, which frankly, without it, is too heavy to lift, not portable, and difficult to pour. In addition, we've had an array of flavors, 24 flavors. It's too complex for our customer, it's too complex for our supply chain, and frankly, it's too complex for our consumer. We're going to have to deploy a more disciplined approach to how we use flavors within Smirnoff. I've also inherited a capacity constraint on small formats. I've approved a $20 million investment in CapEx, which has gone live, which means that not just for Smirnoff, but in fact for a number of our brands, including Crown, we will now have unlimited ability to go after our small format opportunity, starting from the second half of this fiscal and closing out those distribution gaps. The third brand, which has been in long-term decline, is Captain Morgan. For the better part of a decade, we have been losing consumers. In fact, I feel we've lost a generation. Our legal drinking age to 29 is half of what that was in F13. I feel strongly we need to go back to the core DNA of what this brand is about. In its heyday in the US, Captain Morgan was about the instigator of good times, party, high energy. We are going to be bringing the Captain back. Starting with things like this 40-foot ship that we roll in on match day into various urban areas, getting drinks on hand, starting the party. We're going to bring the Captain back on our core point of sale, even on our label, where we've lost the colour and vibrancy and vitality of this brand. We are making changes. And we're going back to simple serves. The number one serve for any rum drink in the US is cola. We had that territory. We're going to regain it. Now, we also need to crack RTDs. The latest innovation we have is Smirnoff Slice Coladas. On the one hand, I like the fact that we're getting into coladas, which is an authentic rum offering. But when you look at this packaging, I feel it doesn't pay enough rent to Captain Morgan. It doesn't amplify. In fact, you might be hard-pressed to actually identify it is from Captain Morgan. So there's something in how we brought the mixes together that we need to significantly improve going forward, and we have started on that already. So 3 brands in long-term decline that require some fundamental fixes, and we're on the case. Now, let me talk to you about a different kind of brand, Don Julio. It's a fantastic brand that grew 40% in F25. Okay? I recognize we're now in decline and losing share. I feel it's critical to regain and expand our quality and craft credentials. Questions have been asked in the US specifically about the quality of Don Julio, and we've been at pains to answer it. We've spoken and we've engaged in advocacy programs with tens of thousands of bar staff, thousands of influencers, and 124 million consumers in the last 12 months. And I'm encouraged now that the consumer sentiment towards Don Julio is now at the levels it was 18 months ago. Now, the other thing we need to do with Don Julio is keep it really culturally cool. Don Julio is the number one talked about spirit brand in the US. Not tequila brand, spirit brand. And we need to continue to work hard at keeping its cultural cachet. Whether that's things like the FIFA 1942 pack, $35 million sold out within 2 weeks, through to Lunar New Year packaging, which Stephanie would have shown you upstairs earlier, all the way through to 1942 being toasted at big celebratory moments like the Oscars. Working hard to keep its cultural credentials is an utmost priority. It's good to see that on the back of FIFA, we've gone back into share growth in the last 7 to 8 weeks in those markets where we've activated. Now, we've seen the whole industry move towards small formats. We have a fantastic, distinctive set of small packaging for Don Julio. It's also really important we lean into this opportunity because Don Julio is the most multicultural brand that we have in the US, and that cohort of consumers right now is under particular economic stress. And so this is a way to allow those consumers access what is a very aspirational brand. And again, closing out those distribution opportunities is top of mind, top of focus. Now, let's talk about the other tequila brand in our portfolio, which really is in different shape because it's been on the slide for longer. And I would argue a lot of that is self-inflicted as we took multiple price increases after COVID. What I've been encouraged by really is this interesting combination of a competitive value proposition combined with awareness building. What FIFA has demonstrated to me is that when you activate at scale, you get out of the lockbox, you get on the floor, you get close to consumers at the right price point, it can be resonant. In fact, that FIFA activation has turned around a 3-year share decline to winning share of total spirits for the last 7 to 8 weeks. I'm not declaring success in Casamigos, but this is an encouraging formula for us to pursue. I'm also encouraged about the traction we're getting with Casamigos margaritas in the cocktail collection, which is growing high double-digit growth. In addition to Casamigos margaritas in the 200 ml can, which when launched was in the top 20 RTD spirit launches that year. Now, unfortunately, we had some packaging issues with that can, with the liner. It leaked. We've had to withdraw it from the market. Right thing to do. We're fixing it. We're getting it back out there before the year end. My bigger point, though, is that Casamigos, great tasting Casamigo margaritas, whether it's in ready to serve or ready to drink, put at bartender quality in the right packaging format is very resonant with our consumers and getting traction. Now let's talk and move beyond the portfolio and talk about our go-to-model organization. I mentioned that I found it cumbersome when I moved there. So we're fixing that. Here are the fixes we're doing. We're moving from 2 divisions, spirits and beer, to moving to a single, under a single commercial leader, where we'll have those reporting in, supported by a single set of support functions and 1 set of key accounts. That is going to improve our agility immensely. Secondly, we're moving from organizing our spirits divisions by regulatory market, open controlled franchise states, to organizing it by geography at state level, where we're going to have state-level decision rights, allowing us to be much more customer-focused and agile. We're going to move from having spirits and beer not having any synergy to spirits and beer being sold by the one team to our national key accounts. Okay? So we're going to have 4 spirits divisions, 1 Guinness division, reporting into 1 commercial leader, supported by 1 set of support functions and 1 national key accounts. More agile, more efficient, more nimble. And then we're going to go from dedicated resource in our distributors that have been very focused on driving distribution to reorganizing our distributor, rewiring them, and re-incentivizing them to not just drive distribution, but to also drive point of sale. And all of that is going to be supported by a significant change in the leadership teams across North America and in the capabilities that I feel we need to go forward. Let's talk about growth. We have a number of brands growing. Grania mentioned Guinness. In its 14th consecutive quarter of share growth in North America, growing since 2023. Guinness Draught is the #1 tap handle in New York, #1 tap handle in Boston. We are still chasing a lot of growth, and as Grania said, we haven't really got after the Guinness Zero opportunity yet, and now we're getting after that in earnest. Ketel One, phenomenal brand. I really like the growth drivers that we have, the made-to-cocktail platform, the fact that we use a lot of brand ambassadors in the on-premise, through to the espresso martini machines that we've deployed widely across the US. We can lean more into that. And we're beginning to get a little bit of traction with Johnnie Walker, right, growing both the top line and share. So leaning into those areas of growth will also be a priority. Let's talk about RTDs. I'll be the first to admit that we're underexposed on the RTD category. It wasn't a priority in the past. It is now. Smirnoff Ice is almost a $500 million brand in the US, growing share and the top line 6%. I've spoken about the cocktail collection through the prism of Casamigos margaritas. But it's not just for Casamigos. We also have Ketel One and Bullet and so forth. That's an interesting collection for us that's beginning to scale and get traction. And of course, I've talked about Casamigos margarita in a can. I feel there's a blueprint beginning to emerge on how we can play a bigger game in ready to drink and ready to serve in North America. So how is all that going to come together? So in F27, my focus is on stemming share loss, becoming more competitive. We deliver that. We anticipate, and these are our assumptions, this is my assumptions, by the way, that we'll deliver mid-single-digit NSV decline. In F28, as we address some of those fundamental issues, we're going to move to holding share and deliver, within that context, low single-digit, and then F29, start winning share. Within spirits, we're going to restore competitiveness through some of those fundamental fixes I've just talked about, and some of those brands have a long-term decline, as well as get growth back in those more recently declining spirit brands, as well as leaning into where we have momentum. RTD, we've got good growth, good momentum. We need to scale it. And finally, we need to lean in on that momentum we have in Guinness. But my focus is on the next 12 months on making the interventions across the portfolio, making the interventions across the brand and the operating model, and making interventions across the leadership team, all in service of getting this business more competitive again.